All right, let's dive right in. Today, we're going to tear apart one of the biggest questions in the world of finance, one that really gets to the heart of this idea of the untouchable genius investor. We are going to untangle skill and luck.
So get this. This quote is from Michael Mauboussin, who is an absolute legend in the investment world. The story goes, when he was a senior in college, he was interviewing for a top Wall Street job, and he was completely bombing. But in his very last meeting, the big boss had a Washington Redskins trash can in his office. Mauboussin, being a fan, said something about it, and they spent the next 15 minutes just talking football. Every other interviewer had voted no on hiring him, but the boss, he overruled them all. And boom, a legendary career was launched by a trash can. Talk about pure luck.
And that story, it just perfectly sets up our big question for today, right? When we see some fund manager with this unbelievable track record, are we really seeing a master at work? Or are we just looking at someone who got really, really lucky with their own version of a trash can?
Okay, let's get into the framework here. First thing you gotta understand is that it's almost never just one or the other. You can think of most things in life, especially investing, as being on a continuum, a spectrum. On one end, you have pure luck, like a roulette wheel. On the other end, pure skill, like a game of chess. The million-dollar question is, where does investing really fall on that line? So to figure that out, we need to be on the same page with our definitions. Skill, that's your ability to take what you know and actually perform. And, crucially, you can repeat it. Luck, on the other hand, well, luck is just when things could have reasonably gone a different way. It's that random chance that can make a great decision look stupid or a terrible decision look brilliant. Now, here's a really clever way to spot skill in any activity. It's called the lose on purpose test. Think about it. Can you lose a game of chess on purpose? Of course, it's easy. But now try this. Can you build a stock portfolio that you can guarantee will lose money? It's actually way harder than it sounds. I mean, you could buy a bunch of struggling companies, and one of them might get bought out and triple overnight. This simple test tells you that investing is a whole lot closer to the luck end of the spectrum than most people are willing to admit.
Okay, so with that framework in mind, let's dig into 3 hard truths that really challenge this whole myth of the all-knowing, never loses stock picker. This is where you can really see just how big a role luck plays. We're going to do this by looking at 3 really powerful concepts. The truth about those crazy outlier performances, the statistical force of what's called reversion to the mean, and a really fascinating idea called the paradox of skill. First up, outliers. You know, when you see a truly record-breaking performance, an investor who beats the market for 10 years straight, it's almost never just skill. Think of it this way. To even be in the game, you have to be skilled, but what pushes a performance from great to legendary? More often than not, it's a huge dose of good luck. Skill gets you a ticket to the dance, luck is what lets you be the star of the show. And this perfectly illustrates our second hard truth, reversion to the mean. It's this powerful force in statistics. This classic example shows that fathers who are way above average in height tend to have sons who are, well, still tall, but a little closer to average. Extreme outcomes tend to be followed by more normal outcomes. In investing, that means a fund that has one absolutely incredible lights-out year is statistically much more likely to have just a good or average year next. That pullback to the average is like gravity. Now, for our third truth, and this one is a real mind-bender, it's called the paradox of skill. And what it says is that as the average skill level in any field goes up, luck actually becomes more important in deciding who wins. Just look at the Olympic marathon. The athletes have gotten way, way better. The winning times have plummeted. But what does that actually do to the race itself? Well, here's the kicker. As everyone got better, they all got bunched up together. The gap between the absolute best and the rest of the pack got tiny. And the exact same thing has happened in investing. The whole industry is now full of incredibly smart, highly skilled people. So the difference between the winner and the loser is razor thin. And when skill levels are that close, what decides the winner? You guessed it, a lucky break, a random event, pure chance. Okay, so let's recap. If crazy good performance is just a mix of skill and luck, if returns are always being pulled back to average, and if skill has become so widespread that it's harder than ever to get an edge, then chasing after a manager's hot track record seems like a really, really bad idea. So what are we supposed to do? And I mean, look at this. This chart is the cold, hard proof. It plots how well mutual funds did in one period versus how they did in the next. If skill was all that mattered, you'd see a nice, clean line going up and to the right. But that's not what you see, is it? You see a random cloud of dots.
the correlation is practically zero. This tells us, in no uncertain terms, that chasing last year's winners is a total dead end. So, this all leads us back to the most critical question of all. If we can't judge an investor by their results, how in the world are we supposed to find the ones with actual, genuine skill? And here it is. This is the single biggest takeaway. It's a complete shift in your mindset. You have to learn to ignore the noisy, luck-filled outcomes and focus all your attention on the investor's process. Is their method sound? Is it repeatable? True skill isn't found in the result. It's found in the process. So, you might be asking, how do you measure a process? Well, one really useful tool is something called active share. All it does is measure how different a fund manager's portfolio is from the index they're measured against, like the S&P 500. If their active share is 0%, they're basically an index fund. If it's close to 100%, it means they are a true stock picker, making big, concentrated bets they really believe in. And this is where it gets really good. When researchers sorted managers by their process, not their past results, over a 20-year period, the findings were just incredible. The closet indexers, the ones who secretly just hugged the index but charged you high fees, they lost money. The managers trying to time big market factors, they lost even more. The only group that actually made money for their clients after fees, you got it, the true stock pickers, the ones with a high active share, the ones with a process driven by conviction. So we know we have to look for a good process. We know what it can do. But what does a skilled investor's playbook actually look like on the inside? What are these people doing? This quote from a legendary horse racing handicapper just says it all. A great process has nothing to do with liking a stock or feeling good about a company. It is all about finding a gap, a discrepancy between what something is worth and what it's selling for. It's a disciplined, analytical game, not an emotional one. You know, a great process also means being a master of your own psychology. It means you have to constantly fight against all these mental traps we fall into, being overconfident in our own predictions, anchoring onto a price we just saw, or maybe the most dangerous one, the confirmation trap, where you only look for information that proves you're already right. And it all comes together in this really simple 3-step framework. First, you work backwards from the stock price to figure out what good news the market is already expecting. Step 2, you do the real work and analyze whether the company can actually beat those expectations. And step 3, the most important one, you only pull the trigger and buy when there's a big enough gap between the price and what you think it's really worth. So let's bring this all home. Once you really understand how much of a role luck plays, it forces you to completely change your approach, to stop playing what some have called the loser's game. See, the loser's game is all about chasing last year's hot stock and obsessing over past results. It's about reacting emotionally to every little blip in the market. The winner's game is the opposite. It's about finding and sticking to sound processes. It's focusing on what the market expects versus what is actually possible. And it's about patiently, analytically, hunting for that gap between price and value. And that's really the big idea I want to leave you with. This way of thinking is a game changer for investing, for sure, but it goes so much further than that. Think about your career, your health, your relationships. Where else in your life might you be confusing skill for luck? And how could focusing more on your process and less on the random outcomes help you make better decisions everywhere?